Hi, I'm Lary Wolf. This is Stuart Gross, and we're talking about the new tax law. The segment we're going to touch upon now is near and dear to all real estate owners' hearts, and that relates to cost recovery, depreciation. And we're going to talk about expensing and bonus depreciation that are benefits enhanced under the new tax law. We're familiar with the depreciable lives of property. Non-residential real estate had and continues to have a depreciable life of 39 years. Residential real estate is 27 and a half years. Some property, qualified leasehold improvement kind of property, has a shorter life, 15 years, and there are various class lives for different kinds of assets. With respect to expensing, certain non-real estate assets can be expensed rather than taking depreciation. And you may elect to expense various kinds of real estate assets, qualified real property, and that includes leasehold improvements, qualified restaurant improvements, qualified retail improvements. Under the old law, the maximum amount that could be expensed in a year was $500,000, and there was a phase out to the extent that your cost exceeded $2 million. The new law increases these limits, so it's now $1 million you can expense, and it phases out over $2.5 million of assets. And the new law expanded the categories of assets that can be expensed to include, if you're furnishing lodging, you can expense beds, refrigerators, stoves, and assets of that category. And with respect to non-residential property, after the building has been placed in service, you can expense roofs, HVAC, fire protection, and alarm systems. That's an expansion of the rules. With respect to bonus depreciation, under the old law, up to 50% of the adjusted basis in the year new qualifying property was placed in service could be taken as an immediate deduction, up to 50%. And qualified property is property that has a recovery period of 20 years or less. So qualified leasehold improvement property, which has a 15-year life, you could claim bonus depreciation and immediately deduct 50% of that cost. Under the new law, the bonus depreciation has gone from 50% up to 100% for certain property acquired after September 27th, 2017. So if you bought property towards the end of last year, you might be able to take 100% bonus depreciation on that property. And this relates to property placed in service before January 1st, 2023, and then it phases out over the next couple of years. A big change to the bonus depreciation rules is that these rules now apply to used property. Previously, it had to be new property, only new property that qualified for bonus depreciation. Now we have used property also qualifying.
So this is a change potentially to someone's 2017 tax return. As long as the property that they bought subsequent to September 27 was not pursuant to a binding contract that was in effect before September 27, they would be eligible for these new rules on their 2017 tax return.
That's right. And this doesn't apply simply to real estate. So Stuart, if you bought an airplane, you could deduct, and you used it in a business, you could deduct 100% of the cost of that airplane.
So maybe it's worthwhile trying to give some idea as to what portions of the building this might apply to. Since I know that if I buy a building, I can't write off 100% of the cost of the building. What parts of the building might I be able to write off 100% of?
With respect to a building, you can write off a portion to the extent that the class life is less than 20 years. So for example, qualified leasehold improvements would be a 15-year life, and you'd be able to write them off immediately. Now, that was clearly the law up until they changed it. They meant to include leasehold improvement property in the 15-year category, but this is one of the glitches in the statute that has to be fixed, and whether it can be fixed by the Internal Revenue Service or whether you need Congress, I don't know yet, but it's clear that they intended 15-year leasehold improvement property to qualify. Unfortunately, in amending the law, they eliminated the section dealing with qualified improvement property altogether, and so there's cross-references that to sections that don't exist. So while we think it's clear that the 15-year rule for qualified improvement property will be the rule, it technically is not there just yet.
And so this confusion means that either I can write this property off entirely if this glitch is fixed or the IRS clarifies that we can read the statute as it was intended to be written, or it's going to be subject to even less favorable rules than it was before.
Right, which would make it 39-year property. So we think that that's going to be fixed, and you'll get 15 years. So in a previous segment, we talked about the consequences of electing out of the interest limitation rules. And if you're a real estate business, an electing real estate business, you can elect not to be subject to interest limitation, but there is a cost. And if you do elect out, then you must use a different depreciable life for the assets you acquire. So residential property, which is written off over 27.5 years, will now have a 30-year write-off period if you decide to elect out. Non-residential property, your office building, will go from 39 to 40, a 1-year difference, not a big deal. Qualified leasehold improvement property, if they fix the statute and you elect out of the interest limitation, then you may have a 20-year life. And if you have a 20-year life, then you're not eligible for bonus depreciation. So once you elect out of the interest limitation, you can't revoke that election, and there's going to be calculations that have to be made as to when and whether it makes sense to elect out of the provision. The rules are not clear. If in year one, for example, I don't elect out of the interest limitation and I write off my leasehold improvements 100%, and then in year two, I elect out of the interest limitation, it's not clear what's going to happen to that asset that you've written off. And we have, this applies more broadly, so that if you do elect out of the interest limitation rules, it's not altogether clear the effect on property that you owned prior to 2018. So if you've been writing off property over, for example, 27.5 years because it's residential property, and then you elect out, you're supposed to use a new 30-year schedule, and whether you have to adjust for prior years' depreciation, it's just not clear yet how those rules are going to work.
These rules also apply to a certain extent on a partnership-by-partnership basis. It appears that the election out from the interest deduction limitation will be made at the partnership level. So this is a reason why it could be advantageous to have different properties in separate partnerships, which is different from what we said earlier in connection with the special 20% deduction for qualified business income. So there may be competing structuring questions, one relating to the limitation on interest deduction and one relating to the 20% deduction for qualified business income, which is why taxpayers and clients and real estate owners need to evaluate their ownership structures and determine what's best under the new law.
The Internal Revenue Service is aware of a number of these issues and hopefully will issue guidance sooner rather than later so that taxpayers can arrange their affairs in the most beneficial manner.